Welcome to the Broken Pie Chart Podcast, episode 67. I'm your host, Derek Moore, and today we're going to be talking about the movie Margin Call and Value at Risk. Okay, what are we doing here? Well, someone had an interesting suggestion for a podcast episode, and they said, they asked me, have I watched the movie Margin Call? And I'll talk about that. It's actually a really good movie and talks about some of the aspects of kind of risk management, and you get into the whole mortgage-backed securities and things like that. They don't overtly say that, but that's kind of what they're alluding to. But they asked me, they said, the whole premise, there's this scene where these two junior analysts and another person, they're talking about sort of risk management through something called VAR, or value at risk. And so I thought I would sort of simplify that and just also talk about the movie, in general. If you haven't seen it, I think, it should be streaming somewhere. I think it's running on HBO right now. And I can't remember what year it was. It might have been 2011-ish or something like that. But, it's got an unbelievable cast. In fact, in one of the IMDb reviews, said if you want to see an acting clinic, watch this movie. And it's got people like Jeremy Irons, Stanley Tucci, Simon Baker, Paul Bettany, Demi Moore, Kevin Spacey, and then Zachary Quinto. And that name might not seem as familiar, but if you see the person, you'll kind of be like, oh yeah, I know who that is. And Penn Badgley, who plays one of the junior analysts. And again, another guy, if you see the movie. And the movie takes place, I think it's essentially over a 24-hour period. And it's supposed to be an investment bank located in New York City. And, one of the things that it is 2011, by the way. And one of the things that they're following is, and so the movie, if you haven't seen the movie, I'll be honest with you, you should probably watch it and then, pause this here and then come back, because it really is a good movie. I was just looking, so HBO, it's on right now. You can also rent it. And I know a lot of people looking for good movies to watch. This one was a little bit under the radar. In fact, I was reading somewhere, I'm not sure if they did direct to rental or if it actually came out with the movies. I don't remember this being out in the movies. I think I saw it. I don't remember how I saw it, but I remember watching it and thinking it was really, really good. And it basically follows an investment banking firm through about a 24-hour period. And it's dialogue. It's really well acted. But essentially what they're doing is they are following. So basically, and here's where the spoilers begin, right? So if you haven't watched it. So Kevin Spacey is in charge of a trading floor. Paul Bettany is one of the traders. And then Stanley Tucci it seems like some sort of, head of risk management or something like that. And you have these junior guys that are in there. And then Demi Moore is kind of upstairs, one of the executives. It's one of those movies where if you see the cast, you're like, oh yeah, I know who those people are. But it starts out where Stanley Tucci's character, Eric Dale, he gets laid off. They're doing these cuts. And so anybody, as they're doing layoffs, they give him a box and they say, collect your things. They have a security guard. But he hands a USB drive to one of the junior analysts on the way out. And he says something like, be careful. And then he, you might remember, he explains he was working on something. And he hadn't quite finished it, and he gave it to the junior analyst and said, see what you can do. And of course, it turns out, I think the junior analyst is, apparently he went to some Ivy League school. Essentially, he was a rocket scientist, but thought the money was better coming to Wall Street. And so what he does is he goes and he looks at these models. He's looking at these risk models, and he apparently completes it. And when he does, he calls, now his boss and one of the other junior guys and says, hey, you got to come back here. And he starts to look at it. And there's the scene where he basically says, what this guy, Eric Dale, Stanley Tucci's character, was looking at was historical patterns, historical risk metrics, and he was using what's called a value at risk. And so value at risk, essentially, let's look at it this way. It's a measure to say it looks at what's happened in the past. And if you just wanted to do a plain vanilla one, not including any sort of assumptions that somebody would add to it, or include volatility or anything like that. But basically what it does, imagine if you ran, let's say you had 100 years worth of returns. Okay, we'll do this easy on a annual basis. And you said, let's sort these, and let's sort them in inverse order. So you think about a long strategy where you're long, and if the markets go down, you lose money. So we'll sort these from 1 to 100, and the first result is the worst year. That's the highest down year. And then the 100th result is the highest up year, okay? And so if you only had 100 results, and you would say, okay, 5% of the time, I would expect to lose less than the fifth from the top one. Remember, the top is the most down year. The fifth is the fifth worst year. And so that's also called, when you do a value at risk or a VAR, you do them at different confidence levels. And so let's imagine that, you run these numbers, and for a 95% confidence, you say, okay, 95% of the time, I should lose less than X. So let's say you're running some numbers and the fifth worst drawdown is negative 21%. You would say, okay, you have a 95% confidence level, or 95% of the time, your results in a year will be greater than negative 21. And you would also say, 5% of the time, then you would have an expectation of losing 21%. And so if you're a firm and you have, it doesn't matter, firm or individual, you would say, okay, and then you put a number on that. So you say at $1 million of a portfolio, you have a 95% confidence that you will lose less than $210,000, right? 21% on $1 million in a given year. And so you would say at a 5% probability, you would expect to lose $210,000, okay? And let's say you did it at the 99% confidence level. That means a 1% probability, right? And let's say that number was minus 34%. So you would say 99% of the time, based upon all these historicals, you would expect to lose less than negative 34%, okay? Now, it's important to remember, markets, and there's that's sort of a normal distribution, and without getting too technical on probabilities and things like that, you would say that if markets returns are normally distributed, you would just say, okay, well, but we all know that, sometimes one of the tails, if you look at the bell curve and the left side or the right side, the left side tail tends to be a little higher. And so some people might argue you can't really do that, but irregardless, that's essentially value at risk, or a VAR. That's what they're talking about. All right. So in the movie, there's this great scene where they're all standing around, and he says, hey, I figured out what Eric was working on. Eric's the character. I think, he was working with some volatility levels. And so what does that mean? Well, I'll explain in a second how, you might use volatility. But he says Eric's numbers were looking at historical patterns. And so basically kind of doing what I was just explaining. And I think they were doing on mortgage-backed securities, and, they had leverage, which brings in, a different thing. But basically what he said was he took historical patterns and he stretched them 10 or 15%. And moves outside of those levels. And, in the movie, he says the losses potentially could be greater than the value of the firm. And so basically what he's saying is the firm had a certain risk assessment, and they had some risk assumptions. But this guy and then the junior analyst figured it out that actually those are wrong. And in the past couple of weeks, they had actually moved outside the levels. And so, which brings about losses. So I will say, okay, so that's, and you think, well, okay, well, the way I explained it with, the 99% confidence and 95% confidence and annualized, just stock market returns, right? But it's a little bit different than that. And you also have the idea of this sort of leverage that comes in. So I'll explain it this way, right? Let's say that, they're at a 5% probability, a market would be down 21%. And you say, well, okay, you can lose 210,000 on $1 million. Okay. And that's based upon just historicals. But what if there is leverage, or the leverage is intertwined, like, using credit default swaps and using X times leverage? You think about back to the long-term capital management, and they were using levels, and you had multi-standard deviation moves, but because of the leverage, kind of wiped them out. So in the way of the movie is, if you moved outside some of the expected volatility-based models, and I'll explain volatility in a second, the losses magnify and are really, really great. And you might remember during the 2008, 2009 crisis period, you saw, credit default swaps or collateralized debt obligations, or, swaps on MBS, mortgage-backed securities. A lot of the risk models were all created based upon historicals and what theoretically or historically, or what the probability was that losses would be, what percent of bond, mortgages would go bad within the bonds, right? So they also talk about volatility, and it's worth noting that, so just, every market that has options, that has something called an implied volatility. An implied volatility is just a fancy way of saying, how much does the options market expect something to go up or down in, let's say, a one standard deviation range? Remember, one standard deviation is 68% of the time you're within here and here, if you can see my hands on a bell curve. And two standard deviations is, how often, what would be the range? And remember, one standard deviation is about 68%. And so if you think about where a market is, in theory, it's, you have a 13.6 or so probability of being to the left side of the bell curve, and a 13.6% probability of being to the right side of the bell curve, right? Because 100 minus 68, and then you divide it by 2. And then at a two standard deviation, it's like, that's roughly 95% of the time. And so you have a little over 2% chance of being to the left or the right in a normal distribution. And then, of course, you get up to three standard deviations, which is, 99.7 to about 100% of the time. So, and markets, of course, can move outside of those levels. But essentially what you're doing with regards to volatility, the options market. So I'll give you an example. If an implied volatility on a market is 10, a one-day, one standard deviation move based upon that would be about 0.6%, so 0.6%. And then you double that for two standard deviations, which would be about 1.25%. But if volatility was 25, implied volatility, a one standard deviation move would go from 0.62 to 1.57, and a two would be 3.14. It's just, another standard deviation from the single. And to kind of give you an example, sometimes you see like Tesla or Netflix, and people talk about, I know it's going to move. I'll buy the call and the put on it. I'll buy a straddle. But those implied moves are based in there, and I've seen stocks right before earnings have something like a 300 implied volatility, and basically what that's saying, it's roughly a 19 rounded about a 19% expected one standard deviation move up or down, and about a 38% two standard deviation move up or down. So basically, you take whatever the implied volatility is divided by the square root of 252, which is 15.875. Anyway, I just go through that to kind of get back to the movies. When they're talking and they're in the office, and basically what they're saying is they had some volatility adjustments to expected moves in the market. And if a market moved X percent, they figured out what the losses would be. And what they're saying is the volatility or the value at risk, the VAR models weren't right. And when the junior analyst finishes it, he's like, hey, we're already moving outside of these ranges. And if they move more, the losses, as I say, could be more than the value of the firm. And so, think about value at risk. The flaw is a lot of times it's based just upon historicals. And as I said, if you had 100 results, but I'll give you an example. Like I think it was Microsoft, and I did the average daily return. And the value at risk 95 percentile would be something like, a minus 2% would be the expected daily return. At the 99% confidence, it would be minus 3.19%. But that's only a year. The more sort of years you have, the more data, the more robust it is. But of course, that has its own challenges. So the movie, though, what it does, it goes beyond the value at risk. And basically, once these guys figure it out, then they got to, go up the chain. They got to start making calls. And Paul Bettany calls his boss, who's Kevin Spacey. I forget the character he plays, who calls, the head of the firm, which is, or his boss. And then he calls the head of the firm, who's Jeremy Irons, and comes in. And then they sort of go through it's basically, meeting and trying to figure out what to do with this stuff they have in the books. Because they figured out if they don't get rid of this stuff, and if they don't get rid of it before everyone else realizes the value should be much lower. So in other words, the value that they were marking to the market, the value that they put on the assets, based upon their analysis, they weren't worth what they thought they were. And so what winds up happening is Kevin Spacey's told, hey, you got to sell this stuff. You got to go ahead and call up everyone that you know. You got to dump the book meaning all the assets, and you got to figure out, just get rid of it. And there's this big sort of interplay between Jeremy Irons and Kevin Spacey with the idea of, hey, I can get rid of this, but we'll never do business with the counterparties again, because essentially you're sticking with things that aren't valuable. And so the one thing, with the movie, it's sort of, unlike The Big Short, and I'll link to the episode I did around The Big Short and credit default swaps and explaining that. But the idea with The Big Short was they actually went in and they sort of explained, you remember they used Anthony Bourdain, they used a couple actresses, singers, to sort of simplify these different terms, CDO squared and credit default swap and, all of that stuff. Margin call didn't do that. And it's one of the reasons why I liked margin call a lot, is they just sort of let it happen and they used the terms that they used. And, I don't know if it was theoretically based upon one of the investment banks. If you Google it, there's people, some people think it was Goldman, some people think it was Lehman. There's different, or Deutsche Bank, but there's different views on that. But I think it was just a really well done movie, really well acted. And if you sort of have a little bit of understanding of this idea of like, okay, here's the problem. We thought the assets are worth this and they're not. And we also thought our risk model would keep us out of, taking X amount of losses, and we were wrong. And they start to talk about when they figured out the model, it was actually really different. So if you haven't watched it, go ahead and check it out. It's on HBO. Doing this episode too got me thinking about, what's some of the best finance or investing movies of all time. I doubt, I think Margin Call is right there up with it. It's, like I said, it's really well done. And in The Big Short, I actually really liked The Big Short as well. I thought it was, really interesting. And, it goes back to Wall Street, the second one that they did, all good movies. And then, there's The Smartest Guys in the Room, the story about Enron. And that one gets interesting. They actually get into the whole mark to market and what they would put as a value on assets. And it turns out that some of the assets they were putting a value on I think they put a factory or somewhere in India, and they based it on future expected profits and brought it back to the present to put a value on the asset. And it wasn't even done yet. It wasn't even built yet. But that's sort of a good movie too. But anyway, let me know if you want me to do episodes on another movie. Let me know what some of your favorite movies are. I appreciate the suggestion to talk a little bit about the value at risk. Hopefully that, makes sense. And hopefully you understand that, the simple way I explained it, just having 100 results and saying, what's the fifth worst? You're like, okay, that's, in theory, that's based upon historical. It's a 5% probability, back of the napkin. And you have a 95% confidence level, you'll lose less than that. And then you can also see that if someone is using a lot of leverage, even smaller changes could start to trigger things. And then you get into, the name of the movie was Margin Call. And in this case, there theoretically wasn't a margin call. But normally what happens is, if you're using a lot of leverage and you're putting up collateral, well, if you have changes and it causes the value of the assets to go down, what can happen is the firm they're being held at can say, hey, we're going to need more money as collateral. We're going to need you to bring in more collateral to hold these assets. And so, it might be worth, I think there's a couple of books on long-term capital management, and, they had values at risk and they had some assumptions, and, some of the markets moved in ways or got, correlations got broke, or they moved, amounts of sigmas. So sigma is kind of, if you move 2 standard deviations, a 2 sigma event, but you move multiple sigmas. The other thing I would tell you too is that I actually ran, I'll have to do it again. And I went back and I ran, I think it was 1928 until, I don't know. I think it was through 2017, 2018. I'd have to look. But I didn't spend too much time of it, but I was just curious. Remember 2008, the markets were down 37%. And I think the probability of that happening, again, just treating it as a normal distribution and just, looking back, I think it was less than 1% from memory that was the probability. So, if you were looking at that, you'd be like, okay, I got more than a 99% probability, or over a 99% confidence that I will lose less than 37% in a year. And so if I have $1 million in the S&P, and, I said, okay, at that confidence level, if the markets went down, I would expect to lose about $370,000 or 37%. But of course, if you're using leverage, it could be magnitudes of that. So rather than waste time, rating and reviewing, go ahead and share this with someone that you think might enjoy it. And plenty of episodes. This is episode 67. So I'd urge you to go back and listen to the prior ones. And by all means, go to razorwealth.com and hit the contact button. Let me know ideas or topics that you want me to cover, or if you just have other questions. All right, folks, we'll talk to you soon.